Today we're talking about taxes.
How they work, what you can do to control them, and why it should matter.
Plus, how a tax plan can give you more spendable money in retirement.
Join us for Retiring Today. Welcome to Retiring Today. I'm here with Sean Honkamp and Loren Merkle. They're both certified financial fiduciaries and retirement income certified professionals, and Sean is a CPA. Today, guys, we're talking about taxes. I know it's something you guys both like talking about. You know, Loren, the average person doesn't really like talking about taxes, but when you're a retirement planner, it's something you get excited about.
It's something we get excited about because if you just think about the mindset shift that has to happen, you go from the working years, you're working 30 years, and all of a sudden you're going to transition into a phase of your life where you're no longer going to have earned income, and you have this finite bucket of resources that now has to last the rest of your life. And one of the most effective strategies to increase your confidence level on the ability to make this bucket of resources last the rest of your life is to do more with this bucket. And one of the ways you can do more is by decreasing your retirement tax bill.
Yeah, Sean, it's so important that we make sure that a long-term tax plan, or you, the retirement planners rather, make sure that a long-term tax plan is part of every single plan that we help families and individuals write.
The tax plan is a big part, just like Loren talked about, so it's one of the areas that we focus on as we help our individuals build that plan. We've got the 6 components that we help them as we help you build your Merkle plan. So today we're going to be talking all about the tax plan. We've talked before about the lifestyle plan. We've got the investment plan. We've got the income plan. We're going to help you with your health care, Medicare, long-term plan, and then also the legacy plan is also an important part of that overall process.
Yeah, and we're doing a show on each one of those plans. We're calling it the Your Merkle Plan series. We're breaking down each one of the components of your Merkle plan. So go to YouTube, search Merkle Retirement Planning if you're interested in any of those things that Sean talked about. But today, guys, it's all about taxes. And really, the shift that you mentioned, Loren, is a shift to having a little bit more control over taxes in retirement. That's how you essentially save money on taxes.
And that's one of the biggest misunderstandings I think about tax planning is we go through our lives and we pay this tax, we pay that tax. It feels like we pay a lot of tax, and it feels like we have very little control over this level of tax we pay. But then we transition to the retirement years, and it just seems like that mentality shifts with us. But one of the most exciting things about retirement planning in retirement is your tax plan, a lot of times for many people, really becomes much more comprehensive. Because when you're in your working years, if you want to decrease the level of tax you pay, there's a couple things you can do. You can make a tax-deductible contribution if you're eligible to a retirement plan, or you can make less money.
I don't hear a lot of people saying, you know what, as I get older and get closer to retirement, I want to make less money.
That's not a very popular strategy. But in retirement, there's so many different levers that you can pull to impact the level of tax that you pay. And this is why we have to focus on your individual tax plan each and every year.
Okay, so somebody watching might be saying, okay, how do I control taxes? How does this work? What does it look like? Well, a good way to understand how you can have more control over taxes is to kind of understand how we pay taxes.
Absolutely. So what we put together for you is we gathered an article that USA Today published last year. And I think this article is really kind of cool from a standpoint that it puts some numbers, it kind of quantifies how much tax we pay throughout the course of our lifetime. So if we just think categorically about some of the taxes that we do pay, well, of course we have sales tax, everybody's familiar with that. We pay taxes on our auto purchases and of course registration every year, and then we have property tax. But you notice this 65% of our lifetime tax bill is equated to our lifetime earnings, our W-2 wages. And again, as we're working, there's little impact that we can make on how much tax that we pay. We can decrease our earnings, we can make a tax-deductible contribution, there's a couple other strategies, but this is where the retirement tax planning really becomes exciting. Because if you have $1 million saved in a pre-tax account, 401k or IRA, an account you've never paid taxes on this money before, and you project out over the course of your 20-year retirement, as you're taking income from that pre-tax account, or maybe even prior to required minimum distribution age, you don't want to, but you have to, you're taking distributions, you're paying ordinary income tax on them. If you add up your total retirement tax bill on that $1 million pre-tax account, it could equate to north of $500,000 just in taxes.
Wow.
So this is where the strategy really comes into play, and should be one of the most exciting things for you. So if you're 2 years away from retirement, you're almost there. There's tax strategies you should be looking at right now to take advantage of taxes while they're on sale. But if you're already retired, many retirees think, well, it's too late, I'm retired, there's not much I can do tax planning wise. And for most retirees, that's not true. So this is why, whether you're a couple years away from retirement or already retired, an effective tax plan should be looked at each and every year to mitigate the impact of your overall retirement tax bill.
And Sean, what I like if I'm heading to retirement is that the biggest piece of that pie is income taxes, because that's where you can control things.
Yeah, so often we're having to help our families understand what having a tax plan means. When we first meet individuals, Loren, how often do we hear it? I've got a CPA, I use a CPA, so I have a tax plan. And in reality, what we find is that when you have that CPA relationship, they're compensated, you're incentivizing them or compensating them to file your tax return for you, which is really a snapshot of what happened last year. So it's a very reactive relationship. When it comes to having that tax plan, we want to be very proactive about it. And that's really our role as tax planners. We work with our families to build that tax plan. Let's make sure that we're aware of the opportunities that we have right now in the current year that we can take advantage to put you in a better position.
And as we still want to illustrate how you have control, it's also important to understand how the brackets work.
Yeah, let's take a look. So we know that there's different tax filing statuses that we have. So the example that we're going to walk through today is, let's look at what the picture looks like for a single taxpayer. So in this example, this single individual has $50,000 of taxable income. Let's take one step back. So taxable income is one definition or one aspect of your tax return. And really what you want to be thinking about too is what's your gross income? So the gross income is going to be the total of everything you earn. And from there, we all get to deduct a standard deduction. So in this situation, this single taxpayer really would have had a gross income of around $63,000. They have a standard deduction that is just under, basically right at $13,000. So it takes you from your gross income down to your taxable income. So we really like to look at that standard deduction as being the zero tax bracket. You don't have to pay any tax on that first portion. Then from there, that's where we have a graduated tax system where we get to fill up the buckets until we get to that total taxable income balance. So for this single individual, the first $10,275 is going to be taxed at the 10%. Then we get to fill up that next bracket. So they're going to have another $31,500 that gets taxed at the 12% tax bracket. And then the remainder to get to their total taxable income is going to then fill up that next bracket. In this case, the remainder of that, the $8,225, is going to be taxed at this 22% tax bracket. So in this case, we hear a lot of times, we hear effective tax rate, we hear marginal tax rate. This taxpayer is going to be at that marginal tax rate of 22%. And then as we try to identify what their effective tax rate is, it's just a little bit of a calculation. You know, we could figure out what percentage that they're paying in total so that you understand what that means to their tax situation.
Yeah, that's a really important point, Sean, because sometimes we hear, well, we don't want this bonus because then we're just going to pay all this extra tax on this bonus, or why would I want this raise because it's going to bump me up into this next tax bracket, then I'm going to owe 22% on all this income and that's really not how it works. And you did a good job illustrating that specific example right there, where if this individual is making $50,000, they're paying a piece of it, they're paying 0% tax, a piece of it they're paying 10, a piece of it they're paying 12, and then a piece of it they're paying 22. And if they make $5,000 more, then they're just paying 22 on that $5,000 more, and it doesn't make them pay 22 on the rest of their income.
Okay, so we've been chatting for about 8 minutes, and we've already learned a lot about how taxes work and controlling your taxes, but we know that you have a specific tax situation that you're concerned about. Here is a great opportunity to talk about your tax situation. It's a 15-minute retirement checkup call. This is a complimentary call that you can make by going to merkleretire.com. But we've got a lot more to talk about when it comes to taxes. How can you control your tax rate in retirement when we continue?
Biking, boating, relaxation? What's your retirement vision? Learn how to take the money you've worked so hard to save and turn it into the retirement of your dreams during our Journey to Retirement workshop. Like getting ready for a trip, getting to and through retirement takes a roadmap. This workshop is the first step to planning your 20 or 30-year vacation. Go to retirewithmerkle.com to register for our Journey to Retirement workshop this week.
Anytime I have even the smallest question about my accounts or what effect the latest tax law might have on my situation, the Merkle Retirement Planning Team is always there and quick to help. I'm so glad they treat you like family. I'm so happy to have such an excellent team working for my future and ensuring I do the best to achieve my financial goals.
Merkle Retirement Planning. Your retirement starts here.
Welcome back to Retiring Today. I'm here with Sean Honkamp and Loren Merkle. They're both certified financial fiduciaries and retirement income certified professionals. Sean is also a CPA. So we're talking about taxes today. How can you control your taxes as you move to and through retirement? Well, guys, one way to control your taxes is understanding the 1040 form, right? Everyone should understand it. CPA over here, right? Easy to understand. Read the tax code, understand the form.
Yeah, part of our process is we do ask our families to provide their tax return. There is a lot of information that we can take away from the tax return. It just helps us understand what you all have going on, and it gives us an idea of what the different opportunities are. So that's a very valuable, very valuable information for us to be able to look at and review for our families.
Yeah, it's basically a recording of tax history of what happened the last year, and even sometimes a couple years prior, where here's the income that you had coming in, here's the source of the income that you had coming in, because some sources of income are taxed differently. Here's what you have from a tax deduction standpoint last year, and it all can leave clues to help us identify what it might look like for the current year.
Yeah, and what we're trying to illustrate for people today is that you do have control over taxes as you get into retirement, and that can be put more money in your pocket. I mean, that's essentially what you want as you head to and through retirement. So another way to illustrate that is to kind of understand when you file taxes where you have some of that wiggle room.
Yeah, I don't know what you guys all do on the weekend, but I spend my weekends often.
Good, he finally got my joke.
This is why you're going to be talking about the 1040.
Looking at the 1040.
Yeah.
So we talk to our families about providing their tax return. Sometimes we get, well, what do you mean? The total tax returns can sometimes be 50, 60, 70 pages. But a lot of times when we're talking to you about the tax return, really it's just the tax return statement. It's oftentimes 2 or 3 pages from a federal standpoint, maybe 2 or 3 pages from a state standpoint. That gives us a lot of the information that we need. So here is a snapshot of the federal 1040 form. And as you can see, there's a lot of information here. Even as I look at it, it makes me want to maybe go sit back down. So I can understand how you guys feel about wanting to be a part of this. If you do it yourself, great for you. If you're using a tax preparer or CPA, that's why they're in business. That's why we compensate them. So we'll zoom in a little bit on the 1040 and just to get a feel for what all kind of information is being reported on there. You can see we've got the top 5, 6, maybe even 7 or 8 lines that all reflect the different types of income sources that a certain individual or couple may have. You've got your wages while you're working. That's often line 1. Then you've got tax exempt. A lot of different tax type of income sources. Tax exempt interest, taxable interest. You've got dividends. IRA distributions, we're looking at line 4 and 5, IRA distributions and pensions and annuities. Most of those sources of income are taxed the same, but even here they'll break it out between the total benefit and how much of it is taxable. We've got another income source, which is Social Security. We get questions all the time about how is Social Security taxed. Social Security is tax advantaged in its own unique way. At the highest level, 85% of your Social Security benefits can be taxable. At the lowest, they might be 100% tax-free. So on your form, you're going to see what the total benefits are, and they're also going to show you what portion of that is taxable. One of the main items, some of the key items that we want to focus on is we get down here, we see line 9 shows total income. Everybody likes to see that. That's why we're all working. Let's get as much income as possible. We've got adjusted gross income, which you get a few deductions that lower how much of that income is taxable. And line 12 is a great one to focus on, the standard deduction. We're having a lot of conversations. People often talk about maybe the mortgage interest, and it's okay to still carry a mortgage because they know they get to deduct that interest, property taxes, things like that. Something you want to be thinking about, since the Tax Cuts and Jobs Act of 2018, that the intent there was to try to simplify some of this entire picture, what we have going on here. The standard deductions were doubled. And since that time frame, roughly 93% of all the tax returns out there are using the standard deduction, and that leaves only 7% out there of all of you out there that are using the itemized deduction. So something to think about. Most of you are not utilizing that mortgage interest, property taxes, things like that, at least from a federal standpoint, on your tax return. Most people are electing that standard deduction, which then it factors into your calculation. We finish going down through there as we take away those standard deductions, if there may be some other deductions that apply to your situation. And then ultimately, what we all want to focus on is that taxable income. We identify what that taxable income is, and then that's where those amounts start funneling in and start filling up those tax tables that we all are aware of and need to understand, which drives ultimately what your total tax is.
Yeah, so it's interesting you talk about the standard deduction. 93% of tax filers will file the standard deduction. One of the questions that we get pretty often is, should I pay off my mortgage? Because the old school thought process is, don't have a mortgage going into retirement. You want to make sure that you pay off that mortgage going to retirement. And then probably starting about 10 years ago, the conversation really shifted to, well, I get this deduction, this interest deduction for my mortgage, so does it actually benefit me? Is it all that important to pay off as I make that transition to retirement? But then starting as of 2019, the filing season, most people are filing the standard deduction, so they're not actually taking advantage of that mortgage interest. And with interest rates so low, the mortgage interest isn't all that excessive anyway. So that will play a role into that decision. Do you pay off your mortgage? And if so, how do you pay off your mortgage? What's the benefit to keeping the mortgage? What's the benefit to paying it off? And the tax return and what you put on the tax return, how you file, goes into that conversation.
And everything you were talking about, Loren, is just a reflection of how everything we do just overlaps. You know, it is a comfortable feeling. People ask a lot about carrying that debt into retirement, and should they do that, or are they losing that? Just everything you talked about. So it's just, again, it's a reflection of all of these 6 components that we focus on. They're all overlapped. We're not in there making individual decisions in any one component. You need to be thinking about that overall picture and what that means to your plan.
And you guys talk about long-term tax planning. What does long-term mean? Are we talking about a year out, 5 years out, 10 years out? When can I start thinking about, when I'm in retirement, I want to try to be in the lowest tax bracket possible?
It's really a combination of all of it. When we do our tax planning strategies, when we implement them, we are looking year by year, but then we're also projecting out over the course of the retirement. So that's how we know. Like I was saying at the board earlier, if you have $1 million pre-tax IRA, chances are if you do no tax planning, you're going to pay in excess of $500,000 of a retirement tax bill just on that account. So the way we know that is we are projecting out over the course of your entire retirement, because that's how we quantify what kind of impact today's tax strategies that you're implementing can have. And so it's really a combination of the long-term analysis versus here's the particular tax laws this year that you can use to take advantage of, and what kind of immediate benefit and long-term benefit will they provide to you.
So 5 years out, or sorry.
Yeah, I mean, it is about that time. Obviously, we never know how long the retirement journey is going to be. We hope it is 20, 30, 40 years of bliss and golden years. But you've got to look beyond that current year. We think about when you're in that accumulation stage, the most common tax plan we have out there, defer, defer, defer. You're looking at that current year, that's really all you're worried about, and then we know we hear it all the time, we're kicking that can down the road. So having that long-term tax plan, sometimes that does mean paying more taxes in the current year than you otherwise have to. You know, a Roth conversion is a voluntary thing, you're showing more income. But if we know that the current tax rate is favorable, that paying off some of that IRS debt at the current tax rates, if that's going to benefit you in the long run, we can show you the value that you can obtain or receive by having that long-term tax plan.
Well, and the other thing is that a lot of families are concerned about is, what is their tax bill after they're gone? Once you pass away, what is the tax bill that you are leaving to your loved ones? And we can identify that through the analysis, and that could impact the strategies that you're incorporating on a year-by-year basis as well. If you're just concerned about your tax bill while you're alive, that could lead you to different strategies. If you're concerned about your total retirement tax bill, even when you're gone, that could lead to different decisions as you go along the way and implement these different tax strategies as well.
Okay, just quick clarify. 5 to 10 years from retirement is a good time to start maybe thinking about this?
Yeah, the sooner the better. And,
Okay.
and certainly if you're closer to that 10 years of retirement, let's hit the 10.
We're not done talking about taxes just yet. You heard Sean and Loren mentioning Roth conversions. We'll show you what that looks like when Retiring Today continues.
The Merkle Retirement Planning Team provides personable and professional expertise unrivaled in this area. They include us in every step of the planning process. The peace of mind provided to us by the Merkle team allows us to fully enjoy this special time of our lives. Instead of feeling snakebit, we feel confident that with the Merkle Retirement Planning Team at our sides, we can navigate any challenge that comes our way.
Merkle Retirement Planning. Your retirement starts here.
Biking, boating, relaxation? What's your retirement vision? Learn how to take the money you've worked so hard to save and turn it into the retirement of your dreams during our Journey to Retirement workshop. Like getting ready for a trip, getting to and through retirement takes a roadmap. This workshop is the first step to planning your 20 or 30-year vacation. Go to retirewithmerkle.com to register for our Journey to Retirement workshop this week.
Welcome back to Retiring Today. Sean Hunkamp, Loren Merkle, and we promised the people an illustration. Loren Merkle, you're going to show them something pretty powerful, a way to control taxes.
We're going to show something pretty powerful. We're going to talk about Roth conversions, and we're going to demonstrate it for a married couple, but we're also, it's applicable for single individuals as well. And sometimes what we talk about at the Journey class is this concept called tax-free Roth conversions.
He had me at tax-free.
Tax-free.
The rest I don't necessarily.
So I'm going to show you a little bit about what that means, but the bigger point is here's some of the opportunity that you have as you're looking to implement some tax strategy. The Roth conversions is one of the most powerful strategies. So as we go up to the board, this is, again, for a married couple. Sean referenced the standard deduction. So in 2022, a married couple has $25,900 of standard deduction unless you're 65 or older, then you have an additional $1,400 of standard deduction per individual. Now, if you're single and you file single, just cut these numbers in half. Your standard deduction is $12,950 with an extra $1,400 if you're 65 or older, and cut these income numbers in half, and that tells you which tax bracket you're in. So you're retired, 62 years old. You haven't started taking your Social Security income, and you have this cash. We get this question all the time. I have this cash. It's making absolutely nothing in the bank. It's driving you crazy. What should you do with it? And you're looking for a safe alternative to the bank, and there's really not a lot of great safe alternative from an investment standpoint. Well, here's a way to get creative to save yourself a bundle on your retirement tax bill and find a really nice place for your cash. Live on your cash for a year. Live on your cash for 2 years, but let's say you do it for 1 year. So you live on cash. How much are you taxed on your cash when you take distributions from your checking or savings accounts? 0%. You've already paid taxes on whatever little dividends or interest that you've received. So you need $60,000 of income. You live on $60,000 of cash, which means you have, again, if you're a married couple, $25,900 of Roth conversion that you can convert. So you can take the money from the pre-tax IRA, shift it over to the Roth IRA, $25,900, not pay any tax on it. But wait, there's more. We want to go further because $25,900 isn't enough. So you can convert an additional $20,550 and pay only 10%. And there's more. If you want to continue to go further, you can convert another $60,000 or so and only pay 12% on it. So when we're talking at the Journey to Retirement, workshop, or we're talking on this TV show or the podcast, and we're talking about how tax rates are on sale, this is what we're talking about. We have to go all the way back to the 1950s before we find another tax bracket as low as 10%. And if we go just to 1980, this 37% tax bracket, which is the highest tax bracket, is 70%. So tax rates historically have been much higher, and most people probably feel like tax rates are going to increase. So if you can use a strategy like this, whether you can do a tax-free Roth conversion or not, because a lot of people can't, but if you can, it's pretty cool. But if you can pay taxes on some of this money at 10, 12, or for some people even at 22%, it can make a big difference over the course of your retirement and what it is you pay in the form of your retirement tax bill.
Yeah,
And Loren, so much of what we do with the planning process is focused on having control of their plan and creating these options. So obviously in your example, people don't just wake up at 62 and have this bucket of cash that they can live off of for 1 or 2 years. And that's why we stress the sooner you can start planning, the better. We often talk about if you're within 10 years of retirement, that's the right time to consider whether or not the timing is right for you to have a retirement plan. That gives us more years to make these planning decisions and put them in a position where they have these opportunities and options within their plan.
And these are the conversations that we're having with our families, going back to the mortgage. If you have cash and you owe $100,000 on your mortgage, would it be better to pay off the mortgage? Or would it be better to keep the low interest rate mortgage and live on cash so you can implement some bigger Roth conversions? All of this stuff is integrated, and these are the conversations that we have.
Yeah, Loren, we've got about a minute left, but we've got to tell people about the Journey to Retirement workshop because you mentioned it during that illustration. Tell people a little bit about what they'll learn and who should come.
Yeah, the Journey to Retirement workshop is really good for those who are within 10 years of retiring or already retired, and you have an interest in each one of those 6 components of the retirement plan: the tax planning, the investment plan, long-term care, Medicare, legacy plan, income plan. All of those are what we talk about. We talk about it in a really cool way through the eyes of a hypothetical couple who have very specific goals. They may match your goals, may not, but there's some strategies you're probably going to be able to take away and implement immediately to have a big impact on your retirement.
If you're interested in attending the Journey to Retirement workshop, here's what you need to know. Go online, you can get signed up today and learn about those components of retirement and how to start your retirement plan. We know there are 6 components to the retirement plan. We've talked about 3 of them so far. We're going to continue talking about the components of your retirement plan on this show. It's Retiring Today, and we thank you for watching.
Biking, boating, relaxation? What's your retirement vision? Learn how to take the money you've worked so hard to save and turn it into the retirement of your dreams during our Journey to Retirement workshop. Like getting ready for a trip, getting to and through retirement takes a roadmap. This workshop is the first step to planning your 20 or 30-year vacation. Go to retirewithmerkle.com to register for our Journey to Retirement workshop this week.